Welcome to America's Commercial Real Estate Show, your source for market intel, forecast, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by my company, Bull Realty. We're commercial brokers in the Southeast U.S. If you want to sell office buildings, retail, senior, self-storage, multifamily, give me a call or just shoot me an email. My email's an easy one. It's michael@bullrealty.com. Wow, we have a fantastic show for you today. You know, one of the things I think is very interesting about the commercial real estate market is how international investors look at the U.S. and what do they think? And of course, it's more of a curious time than normal, right? With the tariffs and America first and our current administration and what's going on there. So, what is happening with foreign investors in the U.S.? Are they allocating more? Less? Are they on pause? Are they going crazy because it's a good time to buy? Are they coming in here and buying it? Let's find out. Please welcome my guest. It's Gunnar Branson. He's CEO of AFIRE. Now, AFIRE is the Association of Foreign Investors in Real Estate. Gunnar, good to see you, sir.
Good to see you, Michael.
Thank you. Now, you guys do a pulse report for you guys on the video. There it is. There it is. And this is kind of cool because you guys talk to all these foreign investors and kind of get the pulse on, you know, what they're doing, what they're thinking, what their plans are, has it changed? And then what I like is you compare it back to previous reports and surveys to kind of see, well, how are things changing? So let's get into that. First of all, when you look at foreign investors, and you guys just did this in August. Here we are; it's just about to be October, but it's recent enough that this is really interesting to me. Foreign investors, what is their interest in buying in the U.S. right now, and how has that changed from your last report to get us started?
Well, you know, I think it's kind of interesting because when we did our last report at the beginning of this year, there was a general consensus that this was probably a good year to invest, that this was a bottom of sorts, and that things were starting to turn up from a fundamental standpoint in terms of the real estate. Fast forward to August, given the amount of friction, the political friction, and the kind of readjusting of the global trading order that is on the agenda's mind, or on the administration's mind, that kind of increase in growth that people expected did not really happen. However, the international investor very much understands the point in time that we are right now in the commercial real estate cycle is a good time. And the fundamentals in commercial real estate in the U.S. are looking positive. However, two of the major kind of regions of the world that invest in the United States, and that would be Canada and Europe, are both essentially on pause. They are holding. They're waiting for some of the noise to settle down so that they can go back to kind of a normal level of investing in the U.S. You know, the U.S. is more than half of the institutional real estate market of the world. So it's very, very difficult for a cross-border investor to avoid the United States, even if they want to. That being said, because of their concerns, certainly around tariffs, also around changing tax provisions. I think within the big, beautiful bill, there was a 899 provision that would have allowed for what has been called a revenge tax. In other words, the ability of the administration to say, you know, because we don't like the trading policy of this country or that country, we're going to tax you 100% on all your investments in our country. That would have been devastating. And certainly not just for the equity market, but for the debt markets. People don't realize how much international debt is a part of our commercial real estate environment or ecosystem. And without that, you'd see debt prices just skyrocketing, not just for commercial, but for residential as well. And I think that's one of the things that held the administration and Congress back. They did not go forward with those provisions in the bill. However, for the first time in our lifetimes, international investors really have a warning light when it comes to potential risk around U.S. tax and regulatory environment. That's not something that people are really worried about in the U.S. You might worry about it with another country, but not the U.S., in great part because of different tax treaties and everything else that have been established for some time. Right now, it's up in the air. And I think part of what the institutional investor that's crossing borders is thinking right now is, let's see how this settles out. But while I'm waiting, goodness, look at that real estate. This might be a time with some of the devaluations that have occurred across the board in different asset classes and with the increasing demand, especially in residential, but also in some cases for Class A trophy level office. Gee, I'd like to have a bit of that. I'd like to be investing in that, but I'm having to hold. Now, that being said, it's not universal. So you're seeing an increase in allocations coming from, for example, the Australians. The Australian supers have quite a bit of capital built up, and the demographics favor them investing for the next 20 years. So they are very interested in commercial real estate in the United States and are ramping up their efforts. Japan also has a large amount of pension money that is looking for smart investments in the United States, and that continues to be optimistic. So we're seeing a switch to a certain extent from the West to the East, with Asia becoming more active, with Europe and Canada slowing down. It would be a mistake, though, to think of this as off on. You still see some investing coming from Europe and Canada. You still see some activity, but it is certainly dampened by the political environment. And I think that's an important thing to kind of keep in mind as you look at it, that over time, over the last year, we've gone from, being somewhat optimistic around the fundamentals to being much more optimistic about the fundamentals. And yet our allocations, we don't expect them to increase from a lot of different regions like Europe and Canada. You're not seeing divestment. You're not seeing people trying to get out, but you are seeing definitely a pause.
Yeah, well, it's good to see Australia interested in the U.S. Remember the first Australian investor I was working with, and he said, "What do you have, mate?" And I'm from the South. I'm like, "We don't call each other mate down here." and, and in Canada, it seems like it would be really tough for anyone in Canada to be thinking about doing business or investing in the U.S. with all the rhetoric they're hearing, right?
Yeah, absolutely. Absolutely. And I think, when you look at most of the European investors, they're pausing because their concerns are around, are primarily around tariffs and tax. When you talk to the Canadians, they are concerned about the same thing. But on top of that, I think a pension plan answering to the general public does have some emotional concerns around kind of how people feel in Canada right now around the U.S. That is moderating somewhat, and I think it will moderate over time. I think it's really odd, and I think very few of us ever expected that we would be facing a room full of angry Canadians at some point. But somehow we managed to anger, some of the culturally one of the more politest countries in the world. But I do think that will subside as we get through this kind of dramatic period of renegotiating and trying to figure out what the new systems are going to be and how the global trade network is going to realign itself. I think it's very much in both the United States' interest and in Canada's interest for us to be working together as much as we can. I think as a economic bloc, North America is incredibly powerful and incredibly important. To divide that up, it just doesn't make economic sense. I don't think it makes political sense either. But we'll see how this plays out. And I think most Canadian institutional investors are waiting to see the dust settle. Once that happens, I think we're going to see more activity.
Yeah, we'll make sure they're not a state, right?
Absolutely.
Now, this is interesting from your report here. 63% of investors have a negative outlook for U.S. cross-border investments, despite promising fundamentals. Versus in 2025, only 42% had a negative outlook. But there's 44% of non-U.S. investors plan some level of increase in U.S. investments. Versus last year, only 24%. So that kind of hits me. They feel like the U.S. is going to be worse economic wise, but they want to increase their allocation. They just think it's a good time to buy.
Absolutely. I don't think the international investor is looking at any different information from the domestic one. Mm-hmm. What we're seeing is, at least for those folks that have worked in the real estate market for more than one cycle, is that point in the cycle where judicious moves into the market make sense. That the buys that you make at this point in the cycle, generally speaking, play out quite well and better than they would at any other time. But again, you're seeing more friction. So it's just difficult for those decisions to be made. It's difficult for the investment committees to pencil it out completely at this point because there's so many uncertainties. There's so many kind of elements that they're not quite sure how bad this is going to hit them. But again, the real estate market looks great. So it's almost like when you have two boats pass each other on the water and the wakes cancel each other out, you're seeing some of that cancellation happening in terms of their sentiments anyway. When you think about where they're investing and how they're investing, the Sun Belt markets have continued to be incredibly strong and are very attractive to the institutional investor, especially as they've seen growth in places like Texas and in Georgia, certainly, and in Florida, Arizona. However, there's some cross currents when you talk about resiliency and talking about energy and water and infrastructure. I think a lot of these markets are starting to see more and more stress in terms of things that may limit growth or risk kind of on a go-forward basis, the growth of valuations and the growth of rents. So I think, a lot of folks are starting to look at, from a regional basis, where's the great performance in terms of housing in particular and affordability of housing. In the past, it was always the Sun Belt. That is not the case now, especially as insurance rates climb and continue to climb in some of these markets, where you're just not seeing the cost arbitrage between the South and the North. I also think that some of those markets that are around the Great Lakes continue to look very attractive in terms of affordability, in terms of availability, and in terms of demand, where you have young people, young talented people figuring out that they can make a living and maybe not pay as much for their housing. So I think there's some changes afoot, and I think it's really important for any investor to maybe question whatever assumptions they had 2 years ago, because I think the markets themselves may be shifting. And one of the things that we asked about in the survey that leads to that is energy and the importance of energy availability and cost. Now, as AI and all sorts of uses for data centers seem to exponentially increase every year, that means the energy consumption from those spaces are continuing to increase. And it's actually, they're taking from the same energy pool that heats and cools our houses and provides energy for our computers so we can have this conversation with each other. So I think part of what a lot of our investors, and about 85% of them, have said that over the next 10 years, they're seeing this as a major component that they need to pay attention to in their underwriting. And whether it's from the standpoint of understanding where the energy is coming from, what the cost is, what the availability is, what the other demands are for that energy in that jurisdiction, as well as whatever conversion is taking place from something that is predominantly carbon related to something that maybe is more renewable, and how will that impact them? I think this is something that people are trying to get a hold of. And you also see quite a few of the organizations that we talk to are also investing in energy. They're also investing in different energy projects ranging across the board in terms of different kinds of energy, but they see energy infrastructure as a key component to the success or perhaps the lack of success of commercial real estate in various jurisdictions. So they are paying more attention to this area than they have in the past. And I think it's one of those areas where we're going to see some fundamental shifts in terms of valuations and in terms of approaches to commercial real estate on a go-forward basis.
Wow. It sounds like you're suggesting they're concerned about power, not only for just the data center business, but just for power in general. If these data centers come in and suck up all the power, do we not have enough for consumption in a submarket or market?
Right. And again, this cuts right to the affordability question. I live in Northern Virginia, where half the data centers in the United States are. And we're seeing energy price increases on a regular basis. And really, we've only seen the beginning of it as the energy is being sucked up so you can do your search on your phone every day.
Yeah, it's something. I used to think that water was the precious resource. Now it's power and water.
Absolutely. And it's important to pay attention to that. A colleague of mine, Mary Ludgren over at Heitman, recommended at one point that we stop thinking about the Rust Belt as the Rust Belt and understand that it's also the water belt. The 20% of the world's fresh water is sitting in the Great Lakes. So paying attention to that, if you are concerned about energy and water, those markets may make more sense on a go-forward basis.
Yeah. Well, you need water to create the rust, right? I mean,
Absolutely.
so Gunnar, what else jumped out to you in this most recent Pulse report survey?
Well, the other issue that I think is kind of, systemic, something that's a big macro trend that I think is impacting commercial real estate, is affordability, residential affordability. We have, depending on who's counting, 7, 8, 9 million units short in the United States in terms of housing units for people, and this is impacting affordability. It means that across the board you're seeing valuation increases and cost increases just to house yourself. And you're having more and more people kind of dropping into that unaffordability place where they're spending more than a third of their income on their housing costs. I think it's interesting to me, that transition and where the affordability is, and a big part of what drove Sunbelt growth over the last couple of decades has been affordability. And I think that has, to a certain extent, evaporated in many of those markets. At the same time, what's standing in the way of affordability is, to a great extent, created by us, whether it's zoning and NIMBYism or efforts by various jurisdictions to basically keep more housing from being built, or enough housing for the people that live there or want to live there. I mean, for example, in New York City, in Manhattan, you're seeing an increase in jobs above where it was in the pre-COVID peak, and yet you're not seeing a commensurate increase in housing, although there's lots of groups and new zoning that's taken place in New York City to allow for more housing in New York. And I think those are very positive things, but we've got a lot of catching up to do in terms of creating more housing for the people that are there. When we asked people what would be the most effective ways to alleviate the housing challenges in the United States, over 75% agreed that public-private partnerships are the path forward. So working hand in glove with government entities and private entities to allow for more housing to be built, very important. I think having really good relationships with those local authorities and jurisdictions, and understanding how we're going to move forward to create more housing and more affordable housing. Rent control is not an answer. Certainly markets that have said we want more rent control, what they've discovered over the last 100 years or so is when you implement rent control, you slow down the creation of new housing. And that gets you right back into the same problem in terms of people not being able to afford the rent. So I think there is more and more enlightenment around this idea that there are better ways for us to create housing and for us to create affordability of housing. And it really is that relationship with the local government. Certainly the federal government can help. And there are incentives and tax incentives that can be created. No one wants to turn down an incentive. That's fantastic to help pencil out these deals. But sometimes simply looking at the parking requirements for a new apartment building can make a big difference in terms of affordability. Maybe just looking at where we allow more density to be built, and for us to be less frightened of density in the neighborhoods that we live in right now, to allow for more housing. I think that's crucial, and every institutional investor I talk to is absolutely concerned about it. And most institutional investors are now in the housing game, whether it's through traditional apartment buildings and garden apartments, or through single-family rental, which has certainly grown over the last 15 years. They are involved in this marketplace and very, very concerned about creating affordability and enough housing for people.
Yeah, good point. And I especially like your point about not in my backyard. I mean, we'll hear municipalities talk about, oh, we need more affordable housing, we need more affordable housing. Then we put some land under contract, have a buyer apply to do multifamily. So, no, we don't want any multifamily.
Right. I mean, yeah, no, and it's tricky because I think people in their minds associate more density and more multifamily as being having a negative impact on the valuation of their home. And most people, their largest financial asset is their home. So it gets very, very difficult to be thinking in an enlightened way about the health of the overall city or the community when you are worried about the value of your house. However, more and more research points to the fact that having enough housing and having multifamily housing, even in your single family neighborhood, can actually increase the value of your homes depending on how it's approached. That it shouldn't be simply a on-off kind of question, that instead intelligent and thoughtful kind of opening up, if you will, to density. The state of California has been very successful with a program over the last few years where they allow people that are on, largish lots in suburban neighborhoods to build some rental housing, maybe turning a pool house into a rental apartment. This is something that's taking off, this idea of accessory dwelling units, but also in cities that are more developed like Chicago saying, you know what, it's okay for you to have a nanny apartment. Maybe you turn your basement into an apartment or something along those lines to create more affordability, because now you can pay your mortgage a little bit more easily with some rent, and you're also creating more housing for people that choose to rent. So again, I think there are ways to be smart about it that don't hurt value. But what's important is that we're not simply putting up a big stop sign to any new growth. And until we get to the point where we're shrinking in population, we don't have enough housing, and we have to provide for that. It's basic infrastructure for the success of a community and an economy to have enough housing for the people that live and work there. If we do that, we're going to be more successful. Where we don't do that, it's just going to get harder and harder and harder to succeed.
Yeah, good point. A lot of investors that we deal with kind of see the market as starting to be in a recovery. They saw the interest rate drop by the Fed as maybe a signal that maybe that's helpful to the commercial real estate. So some folks are thinking this is a good time to buy. In your survey, or do you have a sense from your respondents of how they look at the current interest rate environment related to U.S.? It would seem like if they're cash investors, that maybe this is a great time for them to acquire?
Yes, I think I would be careful on interest rates in terms of the timing on that. Certainly, the Fed lowering does help, but at the end of the day, it's the bond market that decides what our actual interest rates are. And until that market feels comfortable with where things are going from an inflation standpoint, I don't think you're going to see that much relief when it comes to interest rates. That obviously can change, and predicting interest rates is a sucker's game. I'm not going to do it. But I do think you're right. There is a signal that we may be turning a corner, but it's going to be slowish in terms of that turning. I also think that there is enough capital standing by that it may feel very fast once it starts happening. That once everyone feels confident that the market is ready and that it's safe to jump in again, there's so much waiting to come in that I think it'll be a very fast turnaround. So I think anyone who's investing in this market needs to just be wary that it could turn very quickly. You could suddenly see everyone racing to get into the market. You could suddenly see bidding wars happen very quickly. You're not going to have a year of distressed assets that you'll be able to pick up at your leisure. I think it's not going to happen that way. It's going to be pretty quick. I think we've done this every cycle since the early 90s. We've had to remind ourselves that the RTC days will probably not happen again in our lifetimes. We're not going to see that kind of, being able to pick up whole portfolios for 5 cents on the dollar as we saw in the early 90s. It's just we don't have that much time, and we have a lot of capital that is just waiting to play that game as well.
Yeah, and I agree. I don't think we're going to see substantial changes in interest rates, in my broker opinion. If the 10 years hasn't really moved much, and then the last time the Fed lowered the rates, the 10-year didn't go down, and then you look at, well, if the Fed's trying to fight inflation, I just don't see oil going down in value. I don't see or price or housing going down in price or groceries. I think there's still, and then you still have tariffs. So I think we're going to still have inflation. So I think if folks are waiting for material rates to materially drop, I think they're going to be waiting.
And granted, the last 20 years, people made money in real estate basically on interest rates going down. But traditionally, real estate hasn't relied on that as the only way to make money. And I think we have to, basically, we're getting back to basics. We have to invest like real estate investors now. And that means we can't just rely on basically the Fed giving us another point. They may not, but it's time to invest in real estate as a real estate investor.
Yeah. Closing comments, Gunnar, for our audience related to foreign investors.
I'd say this is a difficult time. There's no doubt. There's a lot more friction. But during a meeting our conference that we hosted in Berlin back in June, it was interesting to me because almost to a person, they said, I'm depressed, I can't move forward, and yet I want to. I'm looking at the U.S. market. I think it's healthy. I think there are good fundamentals. This is a good time to come in on a lot of different asset classes and different markets. It's just a question of, can I get past this volatile period, this uncertain period? So I think there's lots of reasons to be optimistic on a go-forward basis. There's lots of reasons to be careful on a go-forward basis.
All right. Well said. We'll leave it at that. Gunnar Branson, thank you for joining us, sir.
It was a pleasure. Thanks, Mike.
All right. And if you'd like to know more from Gunnar Branson, the good folks at AFIRE, their website is afire.org. Do check it out. And thanks for checking out the show. Thanks for sharing the show, if you will. We appreciate your comments and your thoughts. Please connect with us on your favorite social media. Until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. For more podcasts and videos, subscribe and visit creshow.com.